And here's something I mentioned once or twice in my live stream yesterday. Fed ups its Wall Street bailout to $690 billion a week as the news media snoozes and we don't even know what's happening. WallStreetOnParade.com. Yesterday, the Federal Reserve Bank of New York announced that the giant money spigot it turned on for Wall Street on September 17th would actually be growing exponentially beginning today being yesterday. What day? Yeah. The New York Fed will now be lavishing up to $100 billion per day in cheap overnight loans to Wall Street securities trading firms, a daily increase of $45 billion from its previously announced $75 billion a day. In addition, it is increasing its 14-day term loans to Wall Street, a program which also came out of the blue in September, to $45 billion. Those term loans since September have been occurring twice a week, meaning another $90 billion a week will be offered, bringing the total weekly offering to an astounding $690 billion. It should be noted that if the same Wall Street firms are getting these loans continuously rolled over, they are effectively permanent loans. That's exactly what happened during the 2007 to 2010 Wall Street collapse. Some teetering Wall Street casinos received, individually, $2 trillion in cumulative loans that were rolled over for 2.5 more years, without the authorization or even awareness of Congress or the American people. One bank, Citigroup, received over $2.5 trillion in Fed loans, much of them at an interest rate below 1%, at a time when it was insolvent and couldn't have obtained loans in the open market at even high double-digit interest rates. You're an insolvent person, you schmuck. I don't want to hear about your job. You don't make enough. Pay that car loan. Sorry, I can't pay it anymore. Wouldn't it be nice? Oh, lender of last resort, Fed, I need a loan at under 1% for the full value of my car so I can pay them off. I owe them 4.5% on this loan and for 7 years. So I'd like a less than 1% loan at maybe 4 years. I'll make a deal. 4 years, I'll pay that off. Because what I would owe on a 1% loan, let's just do a little math here. We got a little 400 a month car payment. Let's say 400 times 0.045. Well, that would also be, well, that's on the payment, $18 a month. We're not talking that. You're talking of the full amount. So maybe you got a $30,000 car times 0.045, $1,350. Although that'd be a year. Anyways, this is getting out of control now. I'm not about to put 5 years, 6 done. We don't have time. You don't have time for that crap. Bottom line is, would it be easier for you to pay back any loan, any monthly payment at 1% or 4.5%? Again, a house, a mortgage. Imagine getting a 4% loan and then, I only have to pay 1%. Your monthly payment is going to go down significantly. So imagine that. I'm a deadbeat. I'm broke. I should be bankrupt. But I'm going to go ask the Federal Reserve for a loan, and they're going to give it to me. It's a temporary loan, everybody. Relax. It's temporary. It's only for a small amount. And then it turns out it was for years. Well, because I kept going back. I paid it off. I'd pay back what they wanted, and I'd ask for another loan again, and they'd give it back to me. I just, it's called the circle jerk of fun. That's what we, used to call that back in NAM. This latest announcement from the Fed comes on the heels of an October 11th announcement that it is launching a program to buy up $60 billion a month in Treasury bills. And that program will last into at least the second quarter of next year, which means basically a year from now. I mean, we're in the third quarter, whatever, second quarter. What the New York Fed is doing is unprecedented in United States history, and yet you will find no mention of it on any front page of any newspaper today. This is just a partial list of what makes this action unprecedented or highly questionable. Here goes the list. It's just your list. Your list is on my list. No Wall Street crisis has been announced to the public to explain these massive loans and Treasury buybacks. Not one hearing has been held by Congress on the matter. Not one official elected by the American people has authorized these loans. The loans are not being made to commercial banks, which could reloan the money to stimulate the U.S. economy. The loans are going to the New York Fed's primary dealers, which are stock and bond trading houses on Wall Street, who count hedge funds among their largest borrowers. See list below. There's only one bank among the 24 primary dealers. Many of the primary dealers are units of foreign banks. That sounds familiar again. 2008 bailout. A bunch of money went to the foreign banks. Amongst our own, yep, and then the foreign ones. That's funny. Many of the primary dealers are units of foreign banks whose share prices have been in free fall. The Fed is making these loans at approximately 2% interest, an interest rate these firms could not come anywhere close to obtaining in the open market. These same foreign banks are counterparties to mega U.S. banks' derivatives trades, raising the question that this is another bailout of Wall Street's derivatives mess, which is what occurred in 2008. The Dodd-Frank financial reform legislation of 2010 was supposed to rein in this exact type of abuse by the New York Fed, and, in fact, it states that Congress must be informed as to which banks are receiving the money to be sure it's not going, once again, to failing financial institutions, as happened in the last crisis. The Government Accountability Office, when it released its audit of the Fed's bailout program of 2007 to 2010, chastised the Fed for failing to document the reasons it was flinging trillions of dollars to Wall Street and foreign banks. Notwithstanding the GAO's report, the New York Fed is back to its old tricks again. The New York Fed is owned by its member banks in its region. Representatives of these banks sit on the board of directors. It is thus too conflicted to be in charge of this bailout money spigot, which is ultimately backstopped by the U.S. taxpayer if the New York Fed fails. The New York Fed is the regulator of the largest bank holding companies in the United States, but its failure as a regulator is why these same banks needed to be massively bailed out in 2008, and apparently again right now. This system lacks any semblance of checks and balances. The parent organizations of 5 of its primary dealers have admitted to criminal felony counts brought by the U.S. Department of Justice for frauds against the investing public, bailing out felons and Wall Street firms with serial histories of wrongdoing perpetuates moral hazard, thus more wrongdoing and bailouts. Just this morning, the New York Fed pumped out $134.15 billion to Wall Street under its new loan programs. The $45 billion in 14-day loans was oversubscribed by $17.5 billion, meaning the demand for liquidity on Wall Street is growing and not subsiding. Congress and mainstream media failed to do their job in the lead-up to the epic Wall Street crisis of 2008, and they are failing the American people again. I'm going to read you the primary dealers, the list. I want you to pretend to be surprised, because you're not going to be surprised. So pretend to be surprised when you hear some of these mega banks' names. Amherst Pierpoint Securities LLC, Bank of Nova Scotia, New York agency, BMO Capital Markets, BNP Paribas Securities, Barclays, Bank of America Securities, Cantor Fitzgerald, Citigroup Global Markets, Credit Suisse, Daiwa Capital, Deutsche Bank Securities, Goldman Sachs, HSBC, Jefferies, JP Morgan, Mizuho, Morgan Stanley and Co., NatWest Market Securities, Nomura Securities International, RBC Capital Markets, Societe Generale, TD Securities, UBS, and Wells Fargo. The who's who list of who's been bailed out before and who's being bailed out again. And you look at the thermometers, the gold must be exploding. Nope. Silver, sky, nope. Crypto's up, nope. Anything? Nope. Not at all. Because they control everything, including the thermometers, through more paper derivatives contracts. Gold and silver, oh, nope. Paper contracts way outweigh the real thing, and those paper contracts are the ones buying and selling, handing paper back and forth to each other. No gold or silver is actually moving from any warehouse to any person, or nope. Just pieces of paper that are betting on the prices of what these things are today and what they might be next month or the month after. It's just a bet, and I sold it because I think it's going to go higher, and I just made a couple bucks. I'm going to sell it to that guy. And when we find out, it's all rigged. They don't have the silver. They don't have the gold. They have pieces of paper that represent that they do, but they don't actually have it. And that's how they set the price of all this shit. So that they can do this kind of criminality, and you won't really notice it. Well, the price of gold's not really moving in. But massive amounts of people are being bailed out at these banks. Not massive amounts of people. A very small amount of people at these massive banks are being bailed out with massive amounts of money. And again, Dodd-Frank Act. Remember when Dodd-Frank came out? Oh yeah, we're going to do this, we're going to do this. And then it was like almost all gutted. The Senate changed it. Oh, okay, we take that out. Here you go, pass it. Oh, you guys removed the most critical things out of there. But we left that and that. Okay, but those are small. What about the other? Yeah, we take that out. And here we are again with the same problem. Except they realized this time, we're not going to say anything to Congress. We're not going to ask anything. We're just going to do it. We're just going to do it because we're not going to go through that shit show we went through last time and have everyone go, audit the Fed. We don't want that crap again. Makes me wonder if unaudit the Fed bill comes, maybe from Rand Paul, son of Ron Paul. Maybe this time, strategically timed, Trump's ready for it. Okay, ready to back the currency by gold. Yeah, go ahead and do it. We actually audit the Fed. And it's found out that all those numbers and things that I've been giving you and you know about from 2008, yeah, we heard about those. We know about those. But there's some other stuff we didn't know about that's so mind-boggling you're going to want to kill somebody. And for that reason, Donald Trump says, well, here's the solution. We're going to do this. We're taking control back. The Fed's gone. We're going to back our money by gold, blah, blah, blah. Everyone kind of calms down. Okay. And bye-bye Fed. Bye-bye American Pie. An incredible amount of money is all I have to say. And what, if these are loans, what is Wall Street offering up to the Fed as collateral? Treasuries, some more mortgage-backed securities, that old chestnut. Oh, that's right. The houses that aren't worth crap, bundled into AAA-rated stuff. And when they looked at the package, most of the good stuff was in there was crap. Very few AAA-rated mortgage-backed securities. Which means all that you said it's worth, it's not worth. You should be getting back pennies on the dollar because you have foreclosures, dilapidated houses that are all in there. And they said, no, we're going to give the banks 100%, 100 cents on the dollar. Whatever you say it's worth, we agree, here's the money. You don't suppose they're doing that again right now? Probably not. Magic 8 Ball, are they doing that again right now? Outlook is good. Right here. Check this out. Outlook good, son. I'm telling you, this thing might have a spirit inside of it. It seriously gives me the answers that I hope it gives pretty much every time I ask it. That's all I got to say about that.